Welcome to this explainer on Barclays Q2 2026 results. If you've been watching the financial space, you know flawless execution is basically everything right now. And well, Barclays, they just sent a massive signal to the market. Let's unpack the numbers driving this momentum and figure out exactly what it means for the broader financial landscape.
Just think about this number for a second. 16.1%. That's their statutory return on tangible equity for the second quarter, proving their profitability is absolutely surging. Hitting over 16% for a major global bank in a single quarter tells us that their underlying operations aren't just growing, they're hyper-efficient and generating serious returns for every single pound of equity they hold.
To make sense of this incredibly dense 50-plus page financial report, we're going to take a top-down, drill-down approach. We'll cover the big picture, the favorable macro wins, their 5 business engines, how they're managing risks, and finally, the shareholder payoff.
All right, starting right off with Section 1, the big picture, covering upgrades and momentum. Let's look at the overarching numbers setting the tone for their entire year. The big headline? Group income hit £8.3 billion in Q2. That is a massive 16% jump from last year. Double-digit income growth like that doesn't just happen by accident. In fact, it gave management the confidence to upgrade their full-year guidance to approximately £31.5 billion. They're basically telling the market, hey, we're running way ahead of schedule.
Moving right along to Section 2, favorable macro wins, where we'll look at the broader economic setup.
So you might be wondering why all this momentum right now? Well, it really comes down to a highly constructive macroeconomic baseline. We're seeing UK corporate debt to GDP at multi-decade lows, right alongside steady real wage growth. It means businesses have super clean balance sheets, and consumers actually have real spending power. The natural result of this fertile economic soil is exactly what we're seeing, a strong rebound in both businesses and households, borrowing more from the bank.
And geographically, Barclays is operating as a truly transatlantic powerhouse. They're perfectly balanced. Roughly 40% of their income is generated in British pounds, another 40% in US dollars, and the remaining 20% across other currencies. This kind of geographic diversification is huge because it means they aren't overly reliant on any single economy to drive these incredible numbers. Let's pop the hood in Section 3, the 5 engines, for a divisional drill down.
Let's see how their 5 interconnected divisions are actually driving this growth. First up, the domestic core. Both of their UK engines are humming beautifully. Barclays UK drove £2 billion in net interest income, hitting an impressive 20.4% return on tangible equity. Right alongside it, the UK corporate bank is totally dominating its home turf, posting a 21.3% return while successfully expanding both its lending footprint and its deposit share.
Now, what's equally impressive, maybe even more so, is the sheer profitability of their wealth management arm. We're talking a standout 26.9% return for the quarter. Assets under management hit £55.8 billion, and total client assets and liabilities swelled to over $230 billion. Throw in the launch of their new planning and advice service, and this division is essentially operating as a highly efficient, capital-light growth machine.
Over in the investment bank, the story is just as wild. Income surged 20% overall to £4 billion. This was heavily driven by explosive year-over-year growth in advisory, up 53%, and equity capital markets, up a massive 45%. Equity saw a really solid 18% bump, too. The capital markets are clearly waking up, and Barclays is perfectly positioned to capture that deal flow.
The final engine, the U.S. consumer bank, is executing incredibly well, expanding its net interest margin past a highly lucrative 13% and aggressively growing its core retail deposits, which jumped 16% year over year. Even when you exclude the strategic sale of their American Airlines portfolio, this division delivered a solid 10.5% return as they keep rebalancing their mix toward that super important, highly stable retail funding.
Now for Section 4, managing the risks, focusing on hedges, loans, and stability.
Look, generating returns is great, but it means absolutely nothing if you aren't managing risks against potential downturns. To protect that profitability, Barclays is keeping credit quality incredibly tight. Their Q2 loan loss rate came in at 51 basis points. That sits very comfortably at the bottom end of their 50 to 60 basis point through the cycle safe guidance. This is a vital metric, you guys, because it proves they can grow their loan book without sacrificing credit quality.
And hey, if you're worried about their U.S. credit card exposure, especially given some of the broader, slightly scary market narratives out there, the data paints a very different picture. They have a high-quality, super prime customer base with an average FICO score of 756. Delinquency rates actually beat expectations, coming in lower than anticipated, With 90-day arrears staying totally stable, there are literally zero signs of stress here compared to historic U.S. consumer debt levels.
Beyond credit risk, we have to talk about interest rate risk. To protect against future rate cuts, Barclays relies on a structural hedge. Basically, it's just a financial strategy used by banks to lock in fixed yields on deposits over time. Think of it as a protective moat around their net interest income, completely sheltering it from the wild unpredictability of central bank policy shifts.
But a hedge is really only as good as the income it secures. So that begs the obvious question. When do shareholders actually see the tangible benefit of this locked-in yield?
Well, here's the math in action. By rolling off old hedges that were earning between 1.5 and 2.7% and reinvesting at a modeled 3.5%, this mechanism is locked in to deliver over £1 billion in new product income growth. And the best part? This isn't just a short-term bump. This growth is expected to stretch steadily through 2026, 2027, and well beyond 2028.
Finally, let's wrap up with Section 5, the shareholder payoff. Let's talk returns and distributions.
Let's bring this all back to what this top-down execution actually means for investors holding the stock. Because all 5 engines are firing safely and the macro environment is cooperating, Barclays just announced a staggering £2.3 billion in capital distributions, meaning buybacks and dividends for the first half of the year alone. That's up 61% year over year. Looking further out, they're targeting a massive total payout of more than £15 billion for the 2026 to 2028 window.
And this builds perfectly into their multi-year trajectory, proving they're way ahead of schedule. Back in 2023, their baseline was 9%. Their goal for 2026 was just to cross 12%. But sitting at 16.1% right now in Q2, they are on a highly credible, accelerated path to their long-term target of a greater than 14% return on tangible equity by 2028.
I'll leave you with this final thought. Barclays has fundamentally re-engineered its income engine to thrive even when interest rates inevitably drop. So, if they can deliver a 16% return in a transition year, what on earth happens when this optimized, highly hedged machine hits full throttle in 2028? Thanks for joining me on this explainer. Keep analyzing and stay curious.